Well, howdy there, folks, and welcome into today's video. Hope everybody's doing great out there as always. I spent some money today, about $22,000 on a whole bunch of stocks, and we're going to get into what stocks I just bought here today, and I'll just tell you a little bit, because there's a lot of stocks to kind of go through here. I'll just tell you a little bit about kind of the little bullish thesis on why I'm buying these stocks here today and things like that. Hope you guys enjoy this as always. Hope you enjoy me kind of sharing with you the moves I'm making out there in the market. Obviously, a very, very rough day in the market. I think we all know that here today. Russell was down big. NASDAQ had another tough day. Like, that's back-to-back really tough days, 2% plus days. Yeah, you know, it's getting a little rough for the NASDAQ once again here. And so all markets down, pretty much all stocks down. And some of these stocks just got absolutely torn up. So yeah, let's get into this, guys. Hope you enjoyed it as always. Also, if you want to sign up for FTX US, check out the first link in the description down there. And right now, basically, if you use my referral code, you get a free coin with your first $10 in basically trading action there. So pretty darn cool. Alrighty, guys. First stock I bought was Oatly, O-T-L-Y, which is the biggest player in the oat milk industry, which is just a booming sector. They don't just make oat milk. They also make different ice cream type products now that are made with oats rather than made with, traditional milk, I guess you can say. And they also have yogurt products they've come out with and other products. They're just expanding like a beast, okay? And so here today, I bought 1,000 shares of Oatly stock. I paid $4.72 for those particular shares. It was about almost $5,000 worth of shares. This was one of my bigger moves. Oatly is definitely a stock I'm trying to buy very, very aggressively for the next 6 months. I think I have a 6-month window here with Oatly to just add as aggressively as I possibly can. And, because obviously I think there's going to be a whole lot more than a $4 stock in the future years as the company gets more proven out, as they get to profitability, and they keep putting up these insane growth numbers. The market's going to come flying to a stock like Oatly. As far as Oatly goes, this market cap's now under $3 billion, $2.7 billion here today. They have about 300 mil roughly in cash on their balance sheet. Price to sales ratio is about 4 now, which is way too low for a growth company like an Oatly. The stock, this is a 6-month chart, and I'm showing you a 6-month chart on all these stocks that I bought here today. It's been a disaster as far as the stock price has gone, right? Down 64% in the past 6 months. The stock's just gotten absolutely wrecked. And I love to find a company that has a great long-term business model that is getting absolutely shredded in the short term. And that's exactly what I believe I found here with Oatly. A great business model for a long term, like the next 10, 20 years, this business model is going to be amazing. But right now, the stock is not in favor, clearly. It's a $4 stock here today. Now, if we look at its numbers, the numbers don't suggest that it's the end of the world like the stock price does. If you look at their last quarter, they had 46% revenue growth. And if you look at the full year 2021, the company had 52.6% revenue growth. This is one of those very rare companies you get an opportunity to buy where they literally have decades of growth in front of them, right? And this is a type of company that understands marketing, understands how to make a great product, scaling, demand, like it's incredible. So everything across this business model is beautiful. They obviously are a money loser on the bottom line right now, which the market doesn't want any piece of a money losing company for the most part. And honestly, the market doesn't want a lot of stocks right now. But anything that's a money loser, market's like, I don't want you right now. That's perfectly fine with me. I'm not looking to make money in the next 3 months, 6 months. I want to make money in the stock over the next 3 years and 6 years. And so that's why I'm adding pretty darn aggressively right now for the stock. And my plans are to continue to aggressively add Oatly shares for the coming months. Because like I said, these sorts of opportunities where you can get a company like this that's a game changer, that has this sort of growth, that has a decade plus a runway, and is $4 a share. You don't get those opportunities very often, and you don't get those opportunities for too long of a period, so you got to take advantage, okay? Next one up here, HNST, Honest. This is a pure valuation play for Honest. It's not like a super exciting growth opportunity like an Oatly is, but when it comes to Honest, straight valuation. They're taking market share. They're huge in diapers, wipes, like soap products, sanitizing products, all those sorts of things. And they're a revenue growth company. They should continue to be a revenue growth company. They have this one last super tough comp quarter they have to comp against for their sanitizer business, which was booming a year ago and then just obviously fell off as the Rona scare kind of went away. That's a short-term thing that's very negatively affected their numbers, but after this quarter, that's going bye-bye, and then it just becomes about their organic traditional business, which is booming. Their makeup side, their cosmetic side, it's incredible. And so I went ahead and I bought 1,000 shares here today $4.71 I paid for those Honest shares. Honest is a company that I think is going to get profitable within the next year, meaning they'll start to have some actual profitable quarters in 2023. Okay, so this one's actually really, really close to profitability, which is going to be massive for its stock price, in my opinion. When it comes to market cap, it's about $400 million market cap here today, a price to sales ratio of 1.3, which is just comical. It's comical, literally comical. A forward price to sales ratio on Honest, in my opinion, is around, which is looking at the next 12 months, which is around about a 1 or maybe even under a 1 now. It's completely silly. This is a stock that should be at a price to sales ratio of 3 to 4, and it's at 1. You know, it may be even pushing 5 because there are companies in the sector that trade at around a 5 price to sales ratio, which is where this company should trade at, and they're going to grow way more than those other competitors grow as well. They're taking market share left and right. Stock's down 51% in the past 6 months. It's been absolutely devastated, and as a company that, like I said, I think they're going to start having profitable quarters within the next year or so. You know, I've got to add aggressively here, but it's a pure valuation play. I want to be completely clear about that. PayPal, PYPL. PayPal, I would call a pure valuation play as well, with actually really, really nice growth behind it. The type of company that you should expect to grow 15 to 20% revenues year in and year out for quite a few years to go in the future. I bought 15 shares here today. I paid $112 for those shares. That was about a $1,700 move with PayPal here today. When it comes to PayPal stock, this stock's been obliterated. 57% the stock is down in the last 6 months. I mean, just disaster, right? Market cap's down to about 130 billion. It used to be 300 billion-ish. Price to sales ratio of 5, which is extremely low for a company like this. Remember, they own Venmo and PayPal, which are two of the most popular financial related apps in the entire world. Like, that's incredible, right? And so there's a company that's trading at a PE of about 32, forward PE of under 30 right now. Price to book on this one's about a 6. Pure valuation play here, and yeah, I think this is this stock I put into the easy money category, which I don't put a lot of stocks into the easy money category, but PayPal is definitely an easy money stock anywhere around where it's been trading at here recently. Okay, next stock up here, small company, very small company, Avant Brands, AVTBF, ticker symbol on this one. I bought 10,000 shares here today, and I know that sounds like an insane amount, but it's like a 22-cent stock. Okay, so it's not actually as big as it sounds. It's like, whoa, 10,000 shares? It's 22 cents, okay? This is a very small market cap company, probably one of the riskier stocks I'm in terms of just being a very, very small company. Great balance sheet on this company. Norton, the CEO's got his head on straight, just doing a phenomenal job growing this business. I've been just extremely impressed with the growth this company's put up over the last couple of years. And, you know, it's a company that I'm willing to put some chips on the table here. $2,200 I bought here of Avant Brands here today. As far as the company in general, trading at a little over a $40 million market cap. Yes, 40 million, not 40 billion, 40 million. So like I said, super small player in the market in general. Price to book about 1. So yeah, you know, like I said, it's a riskier play. I understand it's a really small market cap, but I think it has tremendous growth opportunity over the next decade, and I really like the CEO. It's a little bit of a bet on the jockey rather than just the horse when it comes to Avant Brands. And if you're ever getting into a smaller market cap company, especially anything under 100 mil, you better definitely believe in the person running that company, because you're taking obviously a lot more risk. As a company like a Coca-Cola, you're obviously taking a very limited risk. On Avant Brands, you know, under $100 million market cap, it's obviously a risk. And so I'm betting on the jockey, not just a horse when it comes to this one. They should put up some very, very nice growth numbers over this year. And the reason being is they got a new facilities and as far as production, all that goes. So definitely very excited about Avant. Corsair Gaming, CRSR. I bought some Corsair Gaming here today. I bought 100 shares. That was a little over $2,000 move when it comes to Corsair Gaming here today at $21.26. Corsair Gaming, a lot of you guys probably know it. They're huge in the gaming sector, huge in the streaming sector when it comes to hardware as well. And type of business model, Andy Paul's been leading this company for like 100 years now. He does a phenomenal job leading it. It's a profit machine. It's a cash flow machine. A balance sheet that's in a good place, and a valuation that's very, very cheap. We'll look at it here in just a moment here. So when it comes to Corsair Gaming, market cap's around $2 billion right now. Price to sales ratio is 1. Forward price to sales ratio is under 1 for this company now. The stock hasn't been as beaten down as some of these other stocks, and that's mainly because it's a profitable company, right? But it's 6 months, it's still down 16%. Like in a normal market, 16% down in 6 months is a disaster. In this sort of market, it's kind of like, oh, whatever, because we've seen so many stocks fall 30, 40, 50, 60, 70, 80% in a 6-month span. So 16% doesn't seem that bad, but 16% is still a big downward move. The reason it's held up better than a lot of the other stocks out there is because This is a straight profit machine. It's a P ratio of 21. Forward P's under 20 right now. Price to book of about 3. So when I look at a Corsair Gaming, I just see this as a great value play, a great value stock, and a type of business model that I think is much more stable than a lot of folks realize it is on Wall Street. It's a company that's went public in the last few years, and you're going to notice a trend. A lot of these companies I'm buying here today, a lot of these companies went public in the last, let's call it 2 years. PayPal obviously is an exception there, but most of the companies I'm buying here today went public in the last couple of years. And so Wall Street's still trying to figure out these and trying to figure them out. The hardest thing for Wall Street is they're trying to figure out a lot of these stocks, okay? And we'll get into the last ones here I bought. They're trying to figure out a lot of these companies during a time period where the Fed's raising rates and you got all that going on. And so Wall Street's very, very confused just in general right now. Never mind you tack on a lot of these companies that are in their first year or two of being a public company. Wall Street's just very, very confused about what the future holds and what the future holds for these companies and things like that. As far as me, I just look at it from the next 5-10 year perspective. I don't care about the next 3 to 6 months. Wall Street gets very, very caught up in the next 3 to 6 months. And what does this mean for the next 3 to 6 months? I'm thinking about the next 3 to 6 years. That's what I care about. And so all this junk we're moving through right now, and the 2022 is just a junk year where we got this massive wall of worry in front of us, right? All this junk's just being thrown at us this year. I'm just kind of putting all that to the side, and I'm just adding companies I love for the long term. And of course, Corsair Gaming is one of those companies. And Wall Street will will understand these stocks long term. They're just at a moment in time where it's tough sledding out there from kind of their perspective and trying to understand this and what's going on in the market and should I really take risk right now and those sorts of things. So, me as an individual investor, I don't have to worry about all that stuff, okay? Next one up I bought here, I think you guys should have expected this one. Some TTCF. I bought 200 shares here today, $2,300 worth of Tattooed Chef. I paid $11.65 for those Tattooed Chef shares. Obviously, you guys know that I love this company, a massive growth company in the plant-based food space, coming out with all these different products, new SKUs. Sell-through has been amazing. We've seen it across the board. And when it comes to a company like Tattooed Chef, it's under $1 billion market cap here today. Price to sales ratio about 4.4. Forward price to sales way under that. Stock's been hammered over the last 6 months, like many stocks, down 36% in the past 6 months on this stock. Price to book about 4 for Tattooed Chef. Great financial statements when it comes to the balance sheet. Income statement's been impressive as far as a revenue category. Obviously the margins and those sorts of things haven't been there for this company, but I think it's very important to remember with a company like a Tattooed Chef. This is a company that, no one ever heard of this company 2 years ago. The fact that they've scaled this fast, when you're scaling that fast, you can't even really worry about profitability. It's just about scale, revenue. And so, this is a company that now over the next 2, 3, 4, 5 years is going to be able to focus on not just growth, but growing profitably. And what you're going to see play out in Tattooed Chef over the coming years, in my personal opinion, is not just a revenue growth story, which is what this story has been about. It's going to be a story about margins, and margins improving year after year after year after year, and maybe even quarter after quarter after quarter after quarter. But not just margins, but then getting to profitability and then starting to get to scale to profitability. And so I look at a company here that has so many levers to pull when it comes to profitability, it's not even funny. And so a lot of people are caught up into the past and looking at this company. Dude, if you've ever scaled a business to hundreds of millions of dollars, which almost probably no one has ever done that before, believe me, and I've seen a lot of companies scale to hundreds of millions of dollars of revenue. You don't do that profitably usually. Usually you're losing money on the bottom line, and then you get to profitability, and you're starting to get to mass profitability. So what they've done is nothing short of extraordinary in the food space, getting into almost every single retailer you want to be in. Now they get that sell-through. They got the velocities moving. They got new SKUs coming out, new products coming out. And like I said, it's going to become a margin story and a net income story over the coming years as well. Now, when it comes to Tattooed Chef here, it's a company that, as far as revenue goes, 30% plus expected in 22, about 24% revenue growth expected in 23. By the way, there's only 3 analysts that cover this stock right now. In my opinion, by the end of this year, there'll be, I would say, anywhere between 5 and 10 analysts that cover it, 5 on the low end, 10 on the high end. As this company scales and gets bigger and bigger, it's going to attract more analysts to start covering it. More investment banks are going to start looking at it. More funds are going to start looking at it. So there would be more pressure to get the analyst community on this one. And being a big growth company in a massive growing sector, it will definitely attract more analysts on it. So those 3 analysts will go to 5 to 10. And although I obviously don't like analysts, I can't deny the fact that there's a lot of folks on Wall Street, a lot of funds and a lot of even institutional money that listened They listen to analysts, and so it's important that you have an analyst community around your stock that's covering it, that's upgrading it, downgrading it, talking about price targets, talking about, the future revenue growth, what they expect for net income. So I think that's going to be a big factor if you think about the stock price of Tattooed Chef as they get more and more analysts on that. By the way, Corsair Gaming, something I forgot to mention in Corsair Gaming that's huge bullish over the future years. They're just getting in the S&P 600 small cap. You want to talk about something that's big for that stock price as far as Corsair. I'm usually very, very caught up into what's going on with company fundamentals, valuations, things like that. But we can't deny the fact that when you get into big indexes, when you get into big ETFs, things like that, that stuff's massive for your stock price, okay? When you get more and more analysts to start covering your stock, that's a big thing for your stock price. And so something like a Tattooed Chef, I look at it as a great long-term opportunity. Obviously, I'm a big buyer of that one. I've been a big buyer of that one, and I don't plan on stopping to buy that. And I could say that for honestly all these stocks I'm buying. These are stocks that I'm planning on adding pretty much this entire year of 2022 and just continue to add shares, add shares, add shares. All these stocks I'm buying here today are all massively under what I believe their stock prices will be 3 years from now, 5 years from now. And so the way I look at it is a Tattooed Chef at $11, if I think that stock's double and triple and quadruple and up over the next, I could say 5 years, which I would say that for every single stock I'm buying here, I expect that to happen. Doesn't mean it will happen with every single stock, but that's what I expect to happen, okay? And so when I look at that, I'm like, I just have to continue to add these shares this entire year because years like this, walls of worries like we were dealing with this year, you don't get those years very often. This type of extreme fear of extreme volatility we've kind of been going through, the wall of worry, that doesn't happen every year. You always have things to worry about, but at this scale, it doesn't usually happen. So that's why I look at a year like this. It's just, I've got to take advantage of as many deals as I can possibly get and just add shares and accumulate and accumulate and accumulate because eventually that breaks. The wall of worry starts to get destroyed, and next thing you know, the market starts moving, the Russell starts moving, the NASDAQ starts moving, a lot of these stocks start moving, and all of a sudden you're up and away, and everybody's like, whoa, remember when we had all those deals, okay? And I don't like to be the one that you're stuck kind of thinking about all the deals we did have at one point, okay? Dropbox, next one I bought here, 200 shares, about $4,500 I paid for those Dropbox shares there. DBX, pretty big ad for me to Dropbox. By the way, this is the first time I've added Dropbox shares in quite some time. But it's at 22 here today, market cap of $8.4 billion in the stock. Price to sales ratio of 3.9 is laughable for a company like a Dropbox. That's a profit machine, a cash flow machine, a revenue growth story. Not like insane like a Tattooed Chef or an Oatly or something like that, but still a strong revenue growth story, like high single digits revenue growth, right? No customer concentration at this company, pricing power, pricing leverage. Stock's been hit pretty hard in the last 6 months, down 19% in the past 6 months here. P ratio of 26 on Dropbox. If you look at the forward P, it's about a 15 right now for Dropbox, right? Because right now Yahoo Finance doesn't update fast enough, but basically market cap on Dropbox is like an 8 something right now. So it's about a 15 forward P. That's ridiculous. I mean, just ridiculous. This is one of the, I would call it, safer business models I can find in the market. Like I said, no customer concentration, recurring revenue stream. People need the product. It's a cloud-related product, right? People like myself have been using Dropbox for I don't know how many years I've been using it for, 6, 7 years or whatever. And, I have no plans to go away from Dropbox. That would be a nightmare for me. So that's not something I'm interested in. I love Dropbox. So when I look at the stock, it's just a pure value play with nice revenue growth. This is the type of company you should expect to grow revenues 5 to 10% a year for years and years to go in the future. And I think Wall Street's going to start to realize how consistent of a business model this will be. And I think long term, it's going to command a forward P of 25 to 35 over time, as the market understands people just continue to use this product. It's recurring. They can go up in price over time, and it's just kind of a thing of beauty. And obviously, they attract new people to the Dropbox all the time as well. Okay. Hope you guys enjoyed this video. Let me know if you own any of these stocks, what stocks you guys are buying out in the market. Love to hear from you in that comment section as always. Also, check out pinned comment down there. That's for my stock market investing mastery course. It's a little course I put together for you guys. It's absolutely a free course, and it's great if you're in your first year or two of investing. I think you'll learn a lot from that, so check that out as pinned comment. Also, if you want to sign up for FTX, check out the first link in the description down there. Yeah, much love as always, guys, and have a great day.